Good morning, afternoon, and evening, ladies and gentlemen. I know we have quite the global audience today, so thank you for taking the time out of your busy schedules to join our webinar. I'm Cam, the financial analyst here at Downhill Financial, and will be the moderator of this webinar. We will be putting everyone on mute as soon as the presentation begins. However, please feel free to ask any questions in the chat, and we will do our best to answer them for you. Just before we start, a few disclaimers to go through for compliance. Downhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed herein. Thank you.
The first quarter has been less newsworthy than the last 4 years, whether speaking about the Oval Office, Brexit, or the pandemic. We see the light at the end of the tunnel for all three. We love to quote Mark Twain in saying, "History doesn't repeat itself, but it sure does rhyme." After all, we had the Spanish flu in 1919 and a moment of disruption before the Roaring '20s, filled with Gatsby-esque euphoria and a stock market bubble. 2019 through the pandemic has some resemblances, and while we will welcome the chance for some of this excitement, certain comparisons to a stock market bubble could be concerning. This is the story of why it isn't leading to changes in our portfolio and what makes us change our views going forward. Cam, we've had some excitement with GameStop and some short squeezes. Can you tell us the story of why this matters in our portfolios?
Now, before we take a deeper dive into this, what is short selling? Short selling is selling an asset that you don't own in the hopes of buying it back at a lower price for a profit. Now, this isn't something new. We've seen it before in the great financial crisis with the likes of Volkswagen in 2008. GameStop was predominantly fueled by the rise of zero-commission brokerage platforms combined with social media, drawing in the younger, more unexperienced entrants into the market, resulting in these wild fluctuations that we saw in late January. Although we don't invest in these high-flying momentum names, so this does not affect your portfolios, but it is something we should be cognizant of.
A lot of people are saying that market valuations are getting too high and in bubble territory. And while there is a truth that markets have gotten expensive, especially when we look at the Shiller PE ratio, which we like to compare and we've used in past economic updates, we still have to make that comparison to current fixed income prices, which are going to all-time lows. And therefore, stock market valuations can go a little higher because there's not an alternative to purchase. So market valuations will get more expensive. We'll get to the tale of two cities of growth stocks versus value stocks, recovery stocks versus COVID stocks. But it's important to note that we're not so concerned with them at the current valuations.
We've discussed market valuations, and it wouldn't be right without mentioning cryptocurrencies and SPACs. You may remember from our last economic update and our analogy to Levi Strauss and the gold rush, along with its many parallels to cryptocurrencies. Now, we saw Bitcoin break the 1 trillion market cap, hitting a high of 60k a few weeks ago, only to tumble down to the low 50ks. The speculative nature of the industry has led a lot of people to question it at every step. But with large institutions getting involved, such as MicroStrategy and Tesla, that has lent a lot of credibility to the space. Now, on the other end of the spectrum, we have SPAC Mania.
Special purpose acquisition companies, or SPACs as they are better known, have taken Wall Street by storm this year. The likes of hedge fund billionaire Bill Ackman, basketball superstar Shaquille O'Neal, and even former Speaker of the House Paul Ryan have gotten aboard the SPAC train in 2020. SPACs are shell companies that raise money by listing on the stock exchange. They have no business plan other than to acquire a company that will eventually go public. As a result, these vehicles are sometimes referred to as blank check companies because investors are taking a chance on the executives behind the SPAC. The money received from investors, who typically buy in at $10 per share with an option to buy more stock later via warrants, is put in escrow while the SPAC executives, or sponsors as they are referred to in filings, set about finding a company to buy. They typically have 2 years to strike a deal, failing which the vehicle is liquidated. So far, SPACs have raised more than $55 billion this year, and acquisitions have reached a combined value of almost $100 billion. The boom has largely been fueled by a number of success stories, such as Virgin Galactic and DraftKings, which went public via SPACs last year. As long as investors are willing to put money in, sponsors are happy to keep launching new SPACs. They pay a nominal sum of $25,000 for a 20% stake in the company, something called the promote, that can eventually lead to a huge windfall if the deal is successful. If history is anything to go by, SPACs are not the best return on investment. An analysis by the Financial Times found that 2/3 of SPACs launched between 2015 and 2019 that had found targets were underperforming their IPO price of $10. It remains to be seen how this new class of SPACs and sponsors will perform.
You've heard me say it many times before, empty vessels make the most noise. And cryptocurrencies, SPACs, IPOs, and many of these other periphery marketplaces are just sounding like that, empty vessels, that there will be a lot of casualties that are coming from them. That is why we're staying away from these markets, but we're paying close attention to them, and we're talking to you about them, because sometimes a ripple can turn into a wave. Right now, the ripples are really being caused by low interest rate environments, lax policies from our governments, and it's coming out through these types of vehicles. And if it takes over, we need to be aware of that coming, and that's where we watch those indexes. For the entire history of our firm, we've been on one trajectory, which has been growth stocks have outperformed value. This versus the typical history, which is that we have typically a 6-year trend of growth stocks doing better, then we revert back to value. This last quarter was the first time in nearly 12 years in which value stocks outperformed growth stocks for a period of time. Now, we don't view that as a real change in trajectory. We don't know if that's going to be the case. We'll have to give that some time to play out. But we do know that some of the sell-off was because those technology stocks that did so well last year had to sell off some to make room to purchase some of the recovery trades, the companies that will do so well in the next year or so when the economy gets back to normal. We're not jumping on that bandwagon just yet because we know that there's lots of news to come when it comes to vaccinations, the economy, and therefore the recovery will be based on those. And we would rather play for the long term, the change in technologies, those moves to the new things, instead of just going back into hotels, cruise lines, airlines, and this such.
ESG, or environment, social and governance, has very much taken over the hearts and minds of many investors, which has really been brought to the forefront due to the pandemic.
Since we first started fires, our ability to harness energy has defined our progress. Energy is inextricably linked to growth. Today, with population growth and economic development, there is a 79% expected increase in global energy demand by 2050. However, our energy sources are rapidly shifting from traditional fuels to clean energy, thanks to advancements in renewable technology and demand-side innovations like EVs. Fossil fuel and nuclear companies historically dominated the market. Consumers had to buy what they were selling, and to use renewable energy involved idealism, government subsidies, or soaring prices. But whilst global news talks about climate change and governments make commitments to go green, innovators have been quietly beavering away, creating practical renewable technologies which generate energy more cheaply than many of their hydrocarbon-based counterparts. For example, utility-scale solar photovoltaic costs fell 82% between 2010 and 2019, making them cheaper than the cheapest fossil fuels. Thus, as European and UK energy demand rises from 2019 to 2025, energy generated from renewables is growing considerably faster, and it's even happening in America. The EIA projects that by 2050, renewable energy will provide 49% of global energy demand, which would lead to an over threefold increase in the renewables market. The economic viability threshold that has been reached means that clean energy has effectively been demonetized, leading to disruptive and deceptively fast exponential growth. An investment in the future.
Renewables have been outperforming their traditional oil and gas sectors, and with Biden's election and the new administration making hefty promises on new green deals, the industry has been on a bit of a tear, riding off the backs of many of the technology names that empower the greener push. We're even seeing cases of large crude oil players such as Saudi Arabia, which is estimated to have the world's second largest oil reserves at 266 billion barrels. Even these behemoths are now having to heavily divest away from the sector and invest in cleaner projects such as the Line in Saudi Arabia, otherwise known as NEOM. Now, with these initiatives, we're seeing increasing investments and flows being driven to cleaner and more efficient projects, and with countries as large as Saudi Arabia being the biggest players in the industry, if they don't have much faith for the future, then we should be paying close attention to these trends. Now, if we take a look at the overall renewable energy generation, 2020 was one of the first years where the price of power generated by renewables was cheaper than many of the established fossil fuels, which has long been touted as one of the reasons for the lackluster uptake in renewables. Furthermore, even in the midst of last year's market drawdowns in March, ESG-focused funds outperformed their vanilla counterparts by a margin of as much as 4%, with investors pouring a grand total of $21 billion into the space. Now, the elephant in the room when it comes to renewable energy is China. Despite China's initiative of becoming carbon neutral by 2060, they still rely heavily on fossil fuels for a large portion of their energy needs. In China's 14th five-year plan, they laid out strict mandates for directing investments and manpower towards these renewable initiatives, as China sees the space as a key strategic asset as part of its wider push for influence. Wind and solar energy capacity generation in China is likely to see a 100% fold increase.
The tale of electric vehicles has been a significant one, especially since last December, Tesla getting introduced into the S&P 500. This means that it's part of nearly every single portfolio out there, but it has a market cap that amounts to almost the value of all the other car companies together. Now, this is naturally an overvaluation, but we know that there's going to be big rollouts and segments that we should be paying attention to. Europe is naturally the leader on these rollouts of making sure that everybody gets into the electric vehicle revolution. But China is naturally the mass producer of these electric vehicles. That leaves us more players that can enter into this marketplace, and the segment that could move towards that new thing, which is the self-driving revolution. There's more opportunities in large conglomerates like Google that own key components that could move this true revolution. While the market cap of Tesla reflects certain aspects, we're more excited about the entirety of the change of that movement.
The tax deadline for filing US taxes has recently been moved to May 17. And for those who are US expats, our filing deadline is June 15th, as always. Either way, with the deadlines approaching, if you haven't made your IRA contributions for 2020, this is a good time to do so. And let's keep in mind that IRA contribution deadline is still April 15th. That is likely to be extended, but there's no official word from the IRS just yet. With that, I would like to invite you to our webinar on Thursday, April 8th, titled IRAs and Other Retirement Plans for American Expats. You can find the link on our website, and we hope that you can join us there for a more in-depth discussion on retirement plan contributions and related topics.
Now, as we move to discuss the stimulus efforts and the various central bank policies that have been enacted to stave off the liquidity crisis and a lot of the downfall from the pandemic, we've seen the $1.9 trillion plan to stimulate the economy and bring about pandemic relief in the US. A large portion of that does revolve around the $1,400 checks to individuals, making less than $80,000 and couples making $160,000. Along with that, a number of other benefits, such as the weekly unemployments, have also been extended until September of this year. Democrats also did try to pass the minimum wage into this bill, but however, some of those plans didn't quite make the final cut. Now, the bigger question is, what's in the $1.9 trillion stimulus package? Well, naturally, a portion of that goes towards the stimulus checks, towards municipalities and governments to shore up their balance sheets and get them through these difficult times. But one of the key trends that we should be focusing on is the investments that are being directed towards the likes of healthcare, transportation, education, and small businesses. Now, naturally, a lot of money is being plowed into these sectors, and it's something that we should be aware of.
COVID-19 is naturally going to be the big story for the economy, even this year, all the way through to most likely 2024. We've articulated that it could actually take place into a roaring full 20s. It will reverberate through the overall market. We don't expect companies like airlines to get back to their pre-COVID levels until as late as 2024. And other businesses like hotels and cruise lines will be a little bit earlier, but most likely more the latter in 2022 or 2023. So when we look at Atisha's chart that we've looked at many a times, we can see that falling off period to where different countries are getting back to normal. We're not expecting to get back to normal, i.e. having the last of the lockdowns coming away until June 21st. One of our clients articulated to us last year the contrast between being in jail and being a hostage. That being in jail, you have that hope of counting down the days till your liberty. Whereas being a hostage, you're counting up the days because you don't know when it will come to an end. We spent a good long year as hostages, waiting for that day, potentially developing psychological impacts from the lack of an end date. Now we are prisoners knowing June 21st or someplace thereabouts will be the time that we can start to really recover and get back to normal. We know the case count is high. We know it will get higher, but the vaccination efforts in Israel, here in the UK, and even some of the hope that's coming through in the United States is giving us that viewpoint of what things will look like ahead of us.
With the weakening dollar in recent months, commodities have experienced a boom, with many flirting at their record highs. Even currencies such as the Aussie dollar and the Canadian dollar have experienced relative strength, much of which can be attributed to China once again firing on all cylinders and doubling down on their industrial efforts to kickstart the economy. Now, during the March 2020 drawdowns, we saw an increased uptick in volatility for both gold and silver as prices whipsawed back and forth. Despite this, silver continues to remain more volatile than gold. One of the reasons for this is, despite gold having sold off in recent sessions, silver continues to flirt with key levels not seen since 2014. On the other end of the spectrum, in regards to the energy complex, we've seen crude oil start to float up towards the $70 region. Now, even though oil prices are no longer in negative territory, energy as a whole sector remains very volatile. The crude oil saga and the negative prices were extensively covered in our Q1 economic update of 2020. Returning to normalcy and pre-pandemic consumption is likely to have a large effect on the viability of the energy sector going forward.
Since 1982, we've had declining interest rates. Nearly 4 decades of one direction territory of making money quarter after quarter, not only on the interest yields, but the increasing valuations of the bonds. This seemed to have taken an end in February, as we saw yields kick up on fears that we would get some inflation. We're not talking about even historic inflation levels of 3 to 4%. We're talking about just over 2%, scared the markets into higher yields and levels where we lost some value on the bond markets. This is making it so that we're wanting to be even more cautionary when it comes to our bond portfolios, which would typically be considered our safe money, and trying to diversify that further through currency investments and through uses of different vehicles instead of just your traditional bonds. The interest rate spikes didn't just hit the US, Europe, and the UK. It also hit Japan and all global markets. So it's something that we'll be paying close attention to. And as always, we're always going to look at what inflation could impact in the rest of our portfolio.
Inflation is very much a story of Cassandra. Everybody knows that everybody else knows that inflation will rise this year and into the future. We've seen this time and time again, where central bankers' default policy has always been to come in, reassure the markets, and drop rates. We saw this back in the Latin debt crisis, where we had to drop rates to save the Western banks from dodgy loans made to Central and Southeast America. Then we had the US savings and loan crisis, again dropping rates. Then we fast forward to the Russian debt crisis and the Asian financial crisis, again dropping rates to save the hedge funds from billion-dollar loans made to Russia and Southeast Asia. Then we had the great 2008 financial crisis, which is very much marred and driven by the subprime mortgage crisis to save the financial system from overinvestment in the subprime mortgage credit derivatives. Then we had the 2012 euro crisis. Again, we dropped rates to save a politically created union with a common currency but not a common government. And fast forward to now, we have COVID-19. Many central banks across the globe went ahead and yet again dropped rates to monetize government deficits and to fiscally support the economy. Now, with all these drops in interest rates, we have to ask ourselves whether policymakers are actually asleep at the wheel. Despite this, we have two scenarios. They can either continue to print money and lower rates, so debt can then be repaid with debased money. This in turn actually supports asset prices, which then supports higher debt loads. So those with financial assets benefit. So those are the haves. The other scenario on the other end of the spectrum is to raise rates. Now, sooner or later, central banks and other policymakers will find themselves at this difficult crossroads, and a decision will have to be made. If they do decide to raise rates at some point, this is likely to affect asset values to some extent. It'll likely cause some debtors to default and force them to hand assets over to creditors. Assets will then naturally fall toward their fundamental ability to generate cash flow. Fundamentals matter? Well, color me surprised. So those earning wages benefit as their labor can now buy more real financial assets. the have-nots. Now, the real conundrum here is, even if interest rates were to rise by 1% or 100 basis points, just that slight increase can have a knock-on effect to many holders of bonds and other interest rate-bearing instruments. Now, the stated goal of the Fed is to keep inflation at 2% on an annual basis. What that actually translates to is a dollar losing half of its value over 35 years at 2% of annual inflation. Now, a young person entering into the workforce needs to, on average, return 50% just to stand still over their working life. That's quite simple if only interest rates and savings were in excess of 2%, but they're not. Now, what this does is it arbitrarily forces everyone to take more risk than they normally would. So if you traditionally had cash savings, you're now looking towards bonds. If you had bonds, you're looking at more exotic forms of bonds like preferreds and convertibles. And if you are in the exotic fixed income, you're now being driven to the equity market, and so on and so forth. Everyone is being forced to take more risk than they would under normal times, all in the name of yield. Thank you, ladies and gentlemen, for attending our webinar. We will now open up to our Q&A session. So please feel free to type your question into the chat box below. Please note that we won't be able to answer any specific personal questions, but would be more than happy to follow up in an email or a private call. Again, I would like to thank you all for attending, and we will be ending the webinar here. Follow-up emails will be sent in the coming days with the recorded webinar and a copy of the slides should you wish to review the material at your leisure. Once again, thank you for attending today's session, and we hope you have a wonderful rest of the day wherever you are.